Okay. Hello, everybody. Thanks for tuning in. My name is Casey Lau, a financial educator and author. And in fact, we have my partner here, PC Wong. We have started this online training course on investing in foreign shares. We connected many years ago, and then we actually launched this course actually for many years also, right? I actually lost track of when we started this one. PC, do you remember?
2015.
2015. Oh, it's 7 years.
Yeah.
And we have members who had actually stayed on with us for the whole tenure of 7 years. So we are very grateful for them to joining us, and also I guess we'll see some of them today as well. And we are going to start the session in like 11 o'clock sharp. So just 2 minutes to go. Maybe just a quick question to warm up everybody. Have you invested in any stocks overseas? So if you are, I guess mostly you guys are in Malaysia. So if you are not in Malaysia, or maybe you're from Philippines or from Indonesia or from Singapore, if you bought any shares outside of the country, just type yes, yes, yes in the chat box. Let us know. Just a quick warm up question. If not yet, then you can just type no. Yup. Okay. Thanks for your response. Mostly yes. Mostly yes, 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 Clement. I saw a name there. I don't know how to pronounce. Tajadi Rahaja, right? PC, do you know him? Is he your friend? Yes, yes,
I
no.
not
I'm not too
sure.
sure. So maybe you can tell us, like, maybe I pronounce your name wrongly. Tajadi Rajada. So where are you from? Because I've never seen this kind of name in Malaysia before. TJ. Okay, TJ. Hi, TJ. So where are you from? Indonesia. TJ is from Indonesia. So how did you know our stuff? Because no, mainly my audience is Malaysian. So probably you connect through PC Wong, I guess. From Facebook, maybe. Thank you very much. Thank you for all your response. Okay. So mostly have invested in overseas before, but there are some no, like Hasrin and NG. So without further ado, let's start the session because PC has a lot of things to share with us today. So over to you, PC.
Yeah, and thank you, TJ, for following me since 2 years ago. Well, today's topic is going to be a sure by fire burner because we are talking about geopolitics. I guess in this issue, there have been numerous takes on why or where the world is heading to. But frankly speaking, looking ahead, things are really not so bright. Well, let's talk about what's going to happen. But before that, just a disclaimer, whatever views that is expressed here is all my own. Please do your own due diligence. We are not financial advisors and nothing here should be taken as a financial advice. So let's talk about the geopolitical turmoil and the rise of the new monetary system. Just for a question, maybe you can say whether yes or no you have heard news of a new monetary system. Okay, then maybe can gauge some of the response. Now, key points of today's presentation will focus on the key factors driving global inflation and what are the causes of a stagflation. And those who believe that we are nowhere near a stagflation, I'm going to prove it that whatever the Fed or ECB or what other central bankers say, it is all mostly smoke and mirrors because the Fed has been proven wrong over and over again. As with Ben Bernanke during the global financial crisis, he proclaimed that the housing crisis is contained. Okay, Then following the implementation of QE, Ben Bernanke said that there's a way to exit out of the QE. And then Janet Yellen, who took over from Ben, later on, before she left, she said that there will never be another financial crisis in her lifetime. And then we have Jerome Powell stating that that the inflation is transitory, that we are going to see prices coming down within the next year or two. And now we are already 2 years ahead of COVID pandemic, but the inflation just keeps on rising much higher. So we also talk about the sanctions and Russia and why it will lead to a global stagflation, okay, with Europe entering a hyperinflated depression owing to the energy and food crisis. And we'll also talk about the potential collapse of the euro and the EU, how the EU could break up, and is the yen next? Then we'll touch on why the Fed will fail to control inflation and be powerless to stop the stagflation. And then we'll talk about a new multipolar monetary system led by the EU and China. Of course, the main leader in the EU is Russia. And then we'll talk about why is this new monetary system different. And then lastly, we'll talk about the geopolitical tensions and how it will play out in the coming years. And before we leave, we'll have a look at what are the sectors that will benefit from this new paradigm shift. So let's talk about global inflation and the factors driving it. Now, for those who are unaware, people normally equate that velocity of money is a good indication of inflation, because as more money is passed around, pushing the velocity of money higher, that means that the economy is heating up. But this is often a wrong assumption, because inflation is essentially the expansion of money supply. So in this regard, okay, by expanding their purchases of assets, major central banks of the world are effectively expanding the supply of money. And price is a laggard which comes after the expansion of money supply. So let's look at the total central bank's assets. And here we are looking at the biggest four that controls about 70% of the global economy. We have the Fed, okay, which their total assets have now reached 8.9 trillion, the ECB 9.5 trillion, the BOJ 5.8 trillion, and the PBOC at 6.3 trillion. Now, although the PBOC has not made any purchases of assets like the Fed, ECB, or BOJ via the quantity easing, buying bonds and such, but the PBOC has been a great influencer in managing the repo and reverse repo, which actually eventually lead to the increase in the central bank's total assets. So over the past 10 years, 4 of the world's largest central banks by total assets, namely the Fed, ECB, PBOC, and BOJ, have collectively printed $16.733 trillion, with the most being printed from 2020 to 2021. And you can see how the impact has actually pushed the Goldman Sachs commodity index to major highs by the end of the Q1 of 2022. Now, why is it that we did not see inflation immediately when they started, printing money? Now, first most, okay, when the money was created, expanding the money supply, we have a lot of companies riding on the commodity wave, and they actually went in to invest heavily in the resource industries. Now, investing heavily in the resource industry doesn't mean that they are actually increasing production, but rather they went on an expansion of acquisition of assets. So because money was cheap then, okay, we see a lot of M&As. So bigger companies were swallowing up smaller companies just to control the amount of resource or to gain control of the services and supply of goods. So there were a lot of M&As, okay, with the intention to control the supply, eventually being the major supplier and therefore reaping the benefits of it. But there was still little being expanded into the infrastructure of the mining companies, and also in expanding the production capacity. So during this period of cheap money, you see that a lot of major corporations were actually buying back shares, okay? Because cheap money is available, nothing beats buying back its own shares, even though the S&P kept rising much higher at every when compared to year-on-year basis. So when this occurred, you know, companies, instead of getting cheap money to invest in mining infrastructure to improve the production capacity, or investing in plant and equipment and labor to improve productivity, we see instead a lot of share buybacks. And a lot of the share buybacks were done during the period where the S&P was cresting higher year-on-year basis. And what we have is when these are actually money that are very poorly spent, because if we see a major correction in the S&P, like what happened in 2020 here, a lot of the value, a lot of the money that is expended is actually being wasted because they buy on the high, okay, and then their shares tank to multi-years low, okay. That is why cheap money only allows the transfer of wealth from the poor and middle class to the richer, because they are not expanding production, they are not expanding the resource capacity to produce, to increase future production, and therefore, we did not see rapid rise in wages, okay. And what happened was when inflation finally beat, there is a lack of human resources, that they actually started to push a lot of money into hiring, okay, and that's why we see rising wages very, very high over the last 2 years. Now, during this period, there were also not a lot of worry in the market, because the Fed has always maintained that inflation is transitory. Now, the Fed always want to play with its narratives, because the Fed is worried that they will lose control of their own narrative, and when it happens, then all hell will break loose, and likely we will see in the coming quarters soon. Now, what is driving inflation now? First most is the Russia-Ukraine war, which is through their own folly, especially the NATO countries, okay, because by restricting Russia's access to SWIFT and banning and restricting Russia imports, especially energy-related products, and Russia's priority to export selectively to friendly countries in retaliation. So what happened is that when you restrict Russia's access to SWIFT, okay, that means that a lot of transactions cannot be carried out. And much more than that, even if certain trade with Russia can be carried out, no takers were there to buy Russian products and put them on the ship, because they are worried that a sudden move or further banning of Russia access to, let's say, financial services such as insurance will leave much of the shippers in a lurch, okay, where the product is now on board, but there's no country that's willing to accept the product. So what we see is that even though certain Russian products are tradable, there's no insurance or no logistic companies wanted to take up the offer to ship to other countries. Now, this lead to a sudden drop in the supply of commodities globally, and Russia is a major supplier of commodities worldwide. So when the EU started to ban Russia energy, they actually banned coal totally. Right now, they are working. Initially, they were very unwilling to buy Russian gas for rubles, but now they are actually agreeing to that. Okay, and they are also working on an oil embargo. Now, all this actually will only push up energy prices. So what we have is that oil has risen 69%, okay, in 1 year. Natural gas have risen 158% in 1 year, and coal has risen 273.5% in 1 year. Now, of course, much of the rise have happened even before the war, and it is driven because of two things. One is that, as I mentioned, a lot of companies did not participate in expanding the production capacity of resources. And the other is the ESG focus on the ESG economy. So much so that the IMF, together with the World Bank, which is centrally led by EU countries, and also the Fed, are restricting investment into fossil fuel. Now, because of that, we see that there is an underinvestment in exploration and development of fossil fuel resources. So even before the war has started, there is already a supply concern, and the war just exacerbates the situation much worse. And on top of that, you know, a lot of people treat that as long as we have renewables, then everything will be okay. Now, that is also quite a wrong assumption, because when we talk about renewables, we have to talk about batteries, we have to talk about batteries minerals, we have to talk about the polysilicon that power the solar that is needed for the solar panels, the silver that is needed as a conductor for solar panels. We have to talk about nickel, lithium. All these are actually located in mines that are very far away from the source of energy. And the cheapest method is still fossil fuel. And then, you know, when we talk about logistic, is there a charging station in the middle of the Pacific Ocean? No. Okay. So this focus on just to delete fossil fuel from the market is a major mistake. Shipping still require fossil fuel. Okay. On top of that, a lot of countries still rely on fossil fuel for their transportation. And fossil fuel is also needed to develop polymers, important polymers that are used in our daily life. Without the polymers, we won't see the plastic, fiberglass, and other types of coatings, very much needed necessities to help the world achieve its the development of new materials as well. So, and the entire inflationary cycle is made worse because Russia is also a major producer of wheat, and wheat have just reached a new record high. Fertilizer, okay, neon gas, titanium, copper, nickel, gold, silver, palladium, platinum, and uranium. Now, banning the import of these products will add to the existing inflationary pressure. And what is more surprising, okay, is that despite what the EU and US wanted to do to crush the Russian economy, we see a reverse that is happening, which means Russia economy still enjoying huge surpluses, while the EU and US are just a step, before inflation, before recession. Okay, so now the other major factor is, of course, the breakdown in supply chains. China is the world's factory, and with its manufacturing base and major port being locked down due to its zero COVID tolerance, they invariably lead to a breakdown in supply chains. Now, although China is gradually lifting the restriction in Shanghai, which is a major manufacturing and import-export hub, Musk actually warned that the supply chain breakdown would last longer than anticipated, because here you see all the ships in the month of March, numbering close to 1,000, are all anchored offshore at the Shanghai port, which means everyone who wishes to load and unload will have to take its cue. And that means that the ships will be there for many long periods, leading to disruption in the just-in-time, type of delivery cycle, and that would cause chaotic movement of goods in the global supply chain. So inflation will just become worse, and I think the Fed is only very wishful or hopeful that inflation would start to tone down when they start to hike interest rate. But more of this later. So shipping rates will remain elevated because, as you can see, now way back during the way back in 2020, the shipping rate is actually more in the 2,000 plus region. But you can see that even though a lot of countries are opening up, it remains elevated. And I think we can see a further uptick moving forward, because there is just not enough ships to move the goods. Now, there are some reports that state that the Chinese zero COVID policy is deliberate. Part of it is because it aims to push the inflation to the Western nations even higher. And the Chinese government is working in collaboration with Russia. Okay. Now, it could be true, or it could be just a matter of circumstance, because China still gauge its success in the in fighting COVID, against other countries. Okay, and that is why the narrative runs both ways. Now, the other factors is during the period of low inflation and low interest rate, companies would rather buy back shares, tend to invest in plant, equipment, and labor to improve productivity. Now, productivity is the center of everything. For those who have followed me since the 2019, where I talked more about the at the start of the year, what is going to happen in that particular year and moving forward. I have often shown a chart that productivity is the center of everything, because productivity helps to bring the cost of goods down, allowing consumption to rise. Okay, and when consumption rises, it leads to more manufacturing, it leads to more investment to further meet the capacity to ensure that the demand is being met. So this allows more jobs to be created, leaving more consumption, and then the economic cycle improves overall and help boost the GDP. Okay, now the resources industry, facing a decade-long bear market, saw little investment interest, leading to low exploration and discovery of new resources and lack of funding to build new mining infrastructure. So companies were more willing to buy back shares than to invest in the mining infrastructure, and that is why today we see high commodity prices. Now, this leads to a sudden surge in prices when supply fails to meet the frantic demand after COVID-19 lockdowns. And for those who follow the Fed's narrative that the economy is strong because consumption is strong, one have to bear in mind that the consumption is driven by not the increase in wages or increase in productivity or the increase in the number of jobs created, but rather driven by free money that the Fed has printed. So that is why we see that the US debt growth has been much higher than the real GDP growth. Now, tight labor market also contributed to the high inflation due to the increase in wages needed to draw talents. And one of the crises that emerged post-pandemic is happening right now in the US and even in China, where you have a culture of not wanting to work, okay, because they feel that they do not meet their requirements of a wage that they can actually meet their own livelihood. And in China, there's a very disturbing culture called the laying down culture, okay? And this has been documented. So because of certain groups of people not willing to work, you see much higher demand for wages in order to ensure that corporations will be able to get the talents that they need. Now, with central banks widely expected to tighten their monetary policies, interest rates are expected to rise. Now, this will exacerbate the availability of funding to expand production capacity, leading to even higher inflation. And inflation can result in hoarding, further removing the ability of goods from the market. And this becomes a very vicious cycle. So stagflation and its causes. Now, stagflation is an economic phenomenon where we have a period of high inflation, little or no GDP growth, and high unemployment. Right now, the Fed is saying that unemployment rate is one of its lowest, okay, in the US history. But if we really want to gauge about the US jobs, I think for those who have followed me would know what I mean. For those who are new, the US jobs report is more often than not massaged to meet the government's narrative, because on the overall, the labor participation rate in the US is still very low, at about less than 63%, much lower than pre-global financial crisis, where the labor participation rate was closer to about 67%. Now, overall in the US, about 95 to 100 million people remains unemployed, although they are in the age where they are considered to be able to be employed. Yeah. So what causes stagflation? Now, high inflation resulting in low consumption, low investment, low productivity, which we have higher wages, but the output remains low, and high interest rate environment. Now, this will impact the GDP and earnings of companies, leading to mass layoff. And in fact, layoffs are right now just started in the US. Stagflation is a nightmare scenario for central banks, as easy monetary policy will only fuel the inflation flames, while a tight monetary policy will only weaken the economy and worsen unemployment. So it is a do will die, if don't do, will surely die scenario. Now, the central banks across the world are tightening their monetary policies amid a major slowdown. The IMF just cut its 2022 and 2023 GDP forecast to 3.6% for both years, from 4.4% and 3.8% respectively. Inflation is forecast at 5.7% in advanced economies and 8.7% in developing economies. And already you can see that how the IMF is also trying to massage the expectations. If we want to talk about advanced economies, inflation in the wider Euro area is right now at 7.5%. Inflation in the US is right now at 8.1% in April. And I can assure you that in the month of May, it will be even higher due to two main factors. In May, gasoline and diesel prices in the US have just reached a new record high, and the global food price indicator have also reached a new record high. So therefore, I think we are going to see much higher inflation in the month of May. So you can see that even the IMF tried to massage expectations of inflation so as to project that, hey, you know, everything is not just as bad, okay? But you can see that a lot of this is just aimed to control further destruction of the one and most important thing, the asset prices of government bonds as well as the stock market. Over the years, central banks have used the stock market as a reflection of the economy rather than the real economy of self, such as in the production of goods and services. Okay, somehow the entire global economy has been financialized. Now, stagflation has arrived and it will get worse. This is because the present inflation is not due to the economy heating up, which means it's not due to increase in demand, due to better growth, better living conditions, okay, but by expansion of money supply, which is purely debt, war, and underinvestment to increase productivity. The stagflation will be reminiscent of the 1971 to 1980 era. Now, the only difference is that we are sitting on a global debt time bomb of more than 300 trillion. Of course, this is just a time bomb, but the nuclear bomb is actually because of the 2.5 quadrillion in derivatives sitting across major G-SIBs. Now, G-SIBs are globally systematically important banks, okay? Right now, we are just talking about debt being just a 300 trillion time bomb, okay? But nuclear bomb is 2.5 quadrillion in financial derivatives. Now, what will worsen the current stagflation? Because of sanctioning Russia. Now, Russia is a major commodities producer, world's third largest oil producer and world's second largest oil exporter, world's second largest natural gas producer and world's largest natural gas exporter, world's sixth largest coal producer, world's third largest thermal coal exporter, and world's fourth largest metallurgical coal exporter, world's largest exporter of fertilizers, world's third largest nickel producer and world's largest nickel exporter, world's eighth largest copper producer, world's largest wheat exporter, world's largest palladium producer, and world's second largest platinum producer. Now, some of you might think that palladium and platinum, is just maybe for jewelry and such. But palladium and platinum are both important materials to actually that are being used, okay, in the production of semiconductors, as well as in the production of catalytic converters in vehicles. So rest assured that if Russia is removed as a source of this supply, we are going to see increase in the cost of vehicles, okay? Already we see that removing Russia from exporting wheat, a lot of economists are in fact projecting that June or July, we would likely see famine erupting in major third world countries. And world's largest gold producer and world's fourth largest silver producer, world's largest exporter of timber, which is why recently there were reports locally that Malaysia timber industry could prosper from this fact that Russia is being removed as the major exporter, and world's sixth largest producer of uranium. So you can see how the imposition of sanctions on Russia can actually shift the equation of commodity supply to to negative. So the other unintended consequences of the sanctions, the world is deprived of an important source of energy and raw materials. Global food production is already in a crisis due to poor weather conditions. In fact, California and Midwest is experiencing major drought. And even among countries in Asia, we are experiencing major thunderstorm, inclement weathers that actually destroy crops, such as what happened in China a few months ago. And I actually touched on this as early as I think 2018 or 2019, when I actually mentioned that the world will enter in a grand solar minima by 2020 due to the absence of sunspots in the sun, which could actually, which is a harbinger of mini global ice age, which means on the northern hemisphere, there will be frost and all those. And we have seen that because the frost have actually impacted Texas wind generation, wind power generation, as well as in Europe. And because of the poor sunlight throughout 2021, Europe is now facing an energy crisis. So all this actually, Western nations have not taken into a lot of consideration when they started sanctioning Russia. It's just a feel-good thing. Hey, you know, we want to destroy Russia. We want to punish Russia. And we will do everything we can within our means to destroy Russia, including our own economy. Global crop production. And this could possibly lead to famine in many escalate. Now, due to the financial sanctions, yeah, I think there was a certain.
Yeah, you're back now.
Okay. Just give me a second, yeah. Okay, now due to the financial sanctions, many logistics and insurance companies refuse to ship Russian goods, making the global shortage of commodities even more dire. Besides the sanctions, Ukraine exports 50% of the world's neon gas, which is an important material used in the production of chips. Since the start of the war, production of neon gas in Ukraine has come to a standstill. Now, this will impact the global supply of chips moving forward. So a lot of people, you know, like last year, they say, hey, you know, the shortage in chips is going to be improved. The situation will improve moving into 2022 and 2023. Now, if let's say 50% of the neon gas, you know, is out of the equation, I can assure you that the production of chips is going to be severely impacted. Now, normally when a major producer is taken off the market, it's not as simple as we'll find another producer, because 50% of the global supply is a huge vacuum to be filled. Just like, you know, taking Russia out of the oil and gas industry. The US right now have to approach Venezuela, a country which is sanctioned for many years, you know, in order to buy its oil. Now, US is a major oil producer, but why is it buying Venezuela oil? Of course, not all are created equally. Now, most of the oil in the US are actually light oil. To refine oil, they need to be blended with heavy oil. And Venezuela is the world's largest, has the world's largest reserve of heavy oil. That is why, you know, it's very important to understand certain allocation of resources throughout the world to really understand how the impact of one resource can lead to disruption in the global supply chain. Now, all the above will result in the stagflation becoming worse. Now, one of the key things I would like to draw is why I see similarity between the 1971 and 1980 stagflation. Now, in 1971 to 1980, we have Lyndon B. Johnson's The Great Society policy funded by debt. Then we have the Vietnam War, and the Vietnam War was started like Ukraine right now, the US supplying military weapons to South Vietnam. And when war erupted, they actually sent a lot of advisors there. And when the threat becomes much worse, they actually put boots in the ground. Now, some global strategies are seeing similarity in the Russian-Ukraine war, because right now the West is supplying a lot of equipment to Ukraine. And despite their denial, there's already some advisors in Ukraine. Now, both events happened in the 1960s, the Great Society and Vietnam War, giving rise to excessive US debt and fueling inflation. In fact, there's also something that happened during the 1960s, where the demand for gold as an inflation hedge was very, very high, leading to the formation of the London Gold Pool. Now, the London Gold Pool was instructed by the US and European banks to control the price of gold so that the US will not be bankrupt by the demand for gold, because at that time, the US was still using the gold-backed dollar. However, the situation became so bad that in 1971, Nixon pulled the US dollar out of the gold standard. And because of that, people have lost confidence in the US dollar, leading to a 1973 energy crisis arising from OPEC's oil embargo following Nixon's move. Of course, by 1976, Kissinger went abroad and secured the dollar against the petroleum from the Middle East, giving rise to the petrodollar. Now, what is the similarity, in to 1971 and 1980, given the current situation? Now, we have easy monetary policy due to global financial crisis, the MAGA by Trump, okay, Make America Great Again policy, the repo crisis, and COVID-19. So all this resulted in a lot of money being printed. Then we have the Russian-Ukraine war. We have excessive global debt from 2008 to 2022, and money printing by central banks, resulting in more than 300 trillion in debt. Now, whoever who thinks that this debt is nothing of concern, let me share with you that this is easily close to 340% of global GDP. Now, 2022, commodities-backed monetary system by Russia. And in 2021, the energy crisis due to ESG guidelines, and 2022 sanctions against Russia. So you can now see the similarity playing out. So hyperinflationary depression scenario in Europe, how is it going to be played out? Now, in 2021, the EU imported more than 40% of its total gas consumption, 27% of oil, and 46% of coal imports from Russia. Because of the war, there's a total ban on coal being enforced, and the EU is in desperate need for other replacements to meet its energy requirement. So the EU has agreed to import LNG from the US, even though it may cost many times more. For those who are unaware, it's not as simple as substituting one gas resource from another. Now, to import LNG from the US, you have natural gas costs plus transport costs via pipeline to the gasification plant, and at the degasification plant, there is a cost being associated with it, to shipping costs via LNG fleet to EU port of call regasification plant, plus regasification costs, plus transport costs to consumers via a gas pipeline. So you can see that every part of the journey, there is an incremental cost compared to the cost of direct import from Russia, where it's natural gas costs plus transport costs to consumers via gas pipeline. So the cost of energy will become very expensive. And we already see that in Europe right now. Now, most important of all, energy is the center of all economic activities. With the cost of energy hitting new highs in Europe, manufacturing facilities are facing mounting operating costs, resulting in some smelters deciding to halt production altogether, creating further shortage of products in the market. Because in a smelting facility, there is high consumption of energy. So much so that I read report that some smelters in Europe have already decided to stop operating. Now, Ukraine manufacturing has also come to a standstill, which is an important source of components and parts for multiple industries in Europe, especially the auto industry. Shortage of components and parts will affect the production of manufactured goods in Europe. Now, Europe mainly imports its grains from Russia and Ukraine, with Ukraine production being severely affected by the war. In fact, it's near zero. While Russia is unwilling to sell its grains to unfriendly countries, Europe will face a simultaneous energy and food crisis. Now, this could lead to mass riots and demonstrations in major European cities as the population goes hungry and cold. Now, on top of that, a recent government report in the EU have stated that because of the impending food crisis, they foresee several millions of African refugees coming to Europe in the coming months. Okay, and that would exacerbate the situation in Europe much worse. So ECB cannot afford to hike interest rates due to high debt to GDP ratio among its members, namely Portugal, debt to GDP ratio of 127%, Italy 150%, Greece 193%, and Spain at 118%. Hiking interest rate could push some of the countries into insolvency and a potential default. The confluence of these factors will cause inflation in Europe to run out of control, resulting in hyperinflation. High input costs in Europe will force many manufacturers to relocate. Those which remain will become uncompetitive. Both will result in massive layoffs, pushing many countries into depression. So let's look at why I think there's a potential for a euro collapse and how it will lead to the EU collapse. Now, I'm not saying that, I'm not reading from a crystal ball or conjuring why it could happen, but let's look at the economic facts that will support this narrative. Now, the ruble has gained 54.5% versus the euro after falling to a low of 147 ruble against the euro immediately after the sanctions. But because of the move from Russia to demand rubles for its energy products, the euro has greatly depreciated. And it is mainly because of the depreciation of the euro and also the yen that drives up the dollar index. So sometimes people say that US dollar is strong because that's the only thing that matters in the world. Actually, it's not really true, because if we look on a comparative basis against commodities, commodities have risen substantially against the US dollar. So this helps explain why that, because of the falling euro, falling yen, and the rise in the US dollar, there is a financial war that is being fought in the open as well as in secret. Now, the gas for rubles put the euro at a disadvantage, as Gazprom could take control of the conversion to the ruble's advantage. So this is why, in the first place, the EU was against this, because they can say that the euro has depreciated and now we are going to hike the exchange rate to our favor. And that could, of course, when they do that, the rubles continue to gain and people will rush in to buy the ruble, because they see the advantage of an arbitrage trade. And due to that, the euro would be forced even lower. So inflation will result in lower GDP growth in the EU. ECB cannot hike rates due to, cannot hike rates. Sorry, just some correction here. The ECB cannot hike rates to combat inflation without putting the peripheral countries at risk of default, which could plunge the EU into a crisis. Because if the peripheral countries default, the EU collectively would have resulted in countries fighting against each other, okay? And on top of that, on the corporate front, hiking interest rate will cause the collapse of many zombie companies, resulting in mass layoffs. The resultant war in Ukraine is already causing a refugee crisis in EU, pushing many governments' finance to their limits. So, when we have in UK currently an inflation crisis, we have the UK government needing to support the refugees coming to UK by giving a £250 subsidy, okay, for these refugees, okay, which created a lot of disgruntled citizens in the UK demanding that why they should support refugees instead of giving more support to the citizens. And this is on top of the massive funding that the UK government has given to Ukraine to support its war effort. So you can see that there's a lot of disgruntled population across Europe right now because they fail to understand, or rather, they not fail to understand, they could not understand why government is putting a lot of money into Ukraine rather than into countries. And even more bizarre, the EU has given its commitment to financially support Ukraine in its war effort, which today has cost it 2 billion euros. So I think this will continue to add on because Ukraine says that we are at the forefront of confronting Russia. If you do not pay us, then we will fail and Russia would then move westwards. So there's a lot of fear propaganda there, okay? And one of the, if you have gone to some YouTube sites, okay, it is even more bizarre. There's now an emerging illegal arms dealing in Ukraine because not all the weapons are used in the war front, but some are siphoned off to, as offer to sell to certain terrorist groups, perhaps, or even to other nations, okay, so that it will enrich some of the oligarchs in Ukraine. Now, all this will eventually lead to the euro falling off the cliff, because you have to understand that if the ECB thinks that inflation is a deep concern, it should have increased interest rate there and then. Why wait? The problem is the waiting game is due to their worry that everything would fall apart. Now, can you imagine that when UK was having 10% inflation during the 1970s, interest rate was actually at 18%. But with such debt, what would 18% cost to the overall economy? So that's why when they say they keep on postponing QT and then they raise interest rate by small increment, that's not the way to fight inflation. If you want to fight inflation, you have to be very aggressive, like what Paul Volcker did in the US during the 1970s. Interest rate was hiked up to 20% by 1980, when inflation was at its peak at 13%. You need several percentage points higher to fight inflation, not mere increments. And that's why, later I will share with you why the Fed is following the ECB path eventually. Although right now they say, they are going to do this, they are going to do that. As I said earlier on, never trust the Fed. Okay, they have been wrong in many times. So just look at the Euro 10-year bond yields. It has risen 406% from 0.31% to 1.57%. And yet interest rate right now is at negative 0.5%. And, just to show that, it's also happening to Euro's largest economy. Let's look at Germany's 10-year bond yield has risen 622%. France 10-year bond yield has risen 625%. Italy's bond yield has risen 140%. Now, you might think that, hey, is Italy better? No, Italy bond yield has already risen so much since before the war. And right now it's just adding another 3 digits to it. Okay, so these are the Euro's top 3 economies. So that's why there's concern. The investors are actually dumping European countries' bonds, giving rise to the higher yield because it's showing a lack of confidence in the euro. So year to date, ECB total assets is valued at 9.12 trillion euros, consisting primarily of sovereign bonds it has purchased via QE. Higher yields are a reflection of the deterioration in the value of the underlying assets because yields are conversely related to the value of the bond. Now, despite the rise in yields, the ECB has no plan to hike interest rate until much later. And you can see that they keep on postponing. Interest rate is still at negative 0.5%. If the ECB is serious in fighting inflation, it would have done so immediately without a wait-and-see attitude. The EU inflation is 7.5% in March. To fight inflation convincingly, the ECB has to hike interest rate to 8%. Now, this could result in debt default by many countries within the EU as investors dump sovereign bonds and move to the safety of bank deposits. The value of the ECB assets will deteriorate further, leading to the ECB having negative equity, which it needs to recapitalize to ensure public trust is maintained. Now, this would create additional financial burden to the EU members. Now, already there's a lack of unity among EU nations, even when it comes to sanctions against Russia. From gas for rubles to oil embargo, there's a huge discontent among the smaller EU nations. However, should the need to recapitalize the ECB arise, the larger nations will have to foot the larger share of the burden, causing discontent among the larger nations. Can you see the dilemma right now? The Russian-Ukraine war will continue to bleed the EU, forcing many countries to rely on the continuation of QE to fund their expenditure. Any debt default as a result of tighter monetary policy will entail a bailout, which would fuel discontent between nations. And if you are unaware, there are a new ruling right now in the EU since the last Europe debt crisis, where instead of bailing out, there's a built-in structure being implemented. That means that people who have money in the banks would be the one that will have to bail out the banks, getting shares in return. Okay, but that will be a worthless bank. So the EU will likely face multiple crises, disruption in economic activities, rising public discontent with their respective governments, resulting in further disunity within the EU. Rising discontent could force some of the countries to leave the EU, leading to its eventual breakup. So I'm merely talking about the chances of how this would unravel to the EU's disadvantage, but the facts here are laid bare for everyone to assess on their own, to at least anticipate what will likely to happen. Now, what is happening to the yen? The yen has fallen 18.8% versus the US dollar in 1 year. So why did this happen? Despite rising inflation at 1.2% in March versus negative 0.4% a year ago, the BOJ has been adamant to cap 10-year bond yields at 0.25%. Again, you can see that the expectation of interest rate hike is way below the inflation. As a result, the value of the yen has fallen. Even more astonishing, the Japanese government recently introduced a subsidy to help the population weather through the high energy costs, which it has to finance through new bond issues. So this is like a never-ending cycle. And for those who think that, property is the best hedge against inflation, not necessarily so. The property price in Japan reached its peak in 1989, and since then it has never recovered to its previous record high. So that means that if the central bank make a poor judgment, okay, and continue with that poor judgment, then you have an entire generation that suffers from deflationary prices, okay? So, and the Bank of Japan has no other option because the government's debt level is too high. Because in 2021, the ratio have reached 263%. Now, this ratio looks set to remain high as the BOJ continues with its easy monetary policy. In 2020, Japan's government deficit spending reached 12.6% of its GDP, which is its highest in recorded history. So when government deficit, keep on plunging lower and lower, okay? Of course, Japan hopes to shore it up that the weaker yen would actually help to improve exports. And therefore, at least having trade surpluses. But then when you look at it, Japan has very little commodities or resources. All of this has to be imported. And because of rising commodity prices, the export market in Japan is going to be hit as well. Okay, as manufacturers have to look at managing their costs. And something has to give. Allow higher interest rate, which tanks the bond market, hence helping to stabilize the yen, or refusing to hike interest rate, but resulting in a falling yen. Now, another crazy thing that the BOJ has done is that they are the major holder of Japan's ETFs, which actually invested in the stock market. So if they increase interest rate, the stock market will tank, then, the situation is even worse for the BOJ. So a falling yen would just fuel higher inflation in the country. Because if you cannot stop inflation, inflation will be out of control. So why, sorry, it's not what, it's why. Why the Fed is powerless to control inflation. And stop the stagflation. So total government debt, where the US is concerned, is 30.5 trillion. Total GDP is 23.6 trillion. Total government debt to GDP is 129%. Total personal debt is 23.2%, is highest in history. Total US debt is at 90.5 trillion. Total US debt to GDP is 383%. Total US debt plus unfunded liabilities, which is at 169 trillion, will mean that it equals to 259.8 trillion or 1,100% of GDP. So a lot of the US unfunded liabilities rest in Social Security as well as Medicaid. So which means that as long as there's any claim against Social Security and Medicaid, it has to be financed by debt, because they are not funded anyhow. So current government budget deficit is at 2 trillion. Current inflation is at 8.1%. Terminal interest rate in 2023, which the Fed is expected to, it will reach, is 3%. Now imagine how can 3% combat an 8.1% inflation? So at 3% interest, let's assuming, okay, at 3% interest rate, US government interest payment will be 915 billion per year, up 111% from 433 billion presently, and constitute 21.8% of its present tax revenue. Now, this is just an assumption that US government debt and tax revenue remain unchanged. Now, often when I highlight this hypothesis, there is question always raised. Hey, but the current treasury yield, okay, at that time is 2% or 1.5%. It means that the US is not paying 3%. They're actually paying that, correct? But we are seeing the US as a country that continually has trillions of dollars budget deficit, which means that all this deficit need to be financed. So as long as a debt has reached maturity, even at lower interest rate, it has to be financed by new issues of US Treasury at a much higher interest rate. So that's why, as long as the US government debt continue to grow, it needs to be continually be refinanced, okay? And that is why, as long as interest rate continue to grow, the US debt payment would be much higher. So now, as comparison, the Fed hiked the federal Fed funds rate to 18% in 1980 in order to fight rising inflation from 1971 to 1980. When inflation was above 8% in 1982, the Fed funds rate was sitting at 12%. To beat the current inflation, the Fed will have to hike much higher than 3% terminal rate expected in 2023. Now, given that it needs to hike to 12% because Powell's narrative is that we will do everything we can to bring inflation down. Okay, let's see that they hike it up to 12%. US government interest payment will be 3.7 trillion per year. That is almost 70 to 75% of its tax revenue. A feat that is impossible given the current debt situation. And the tax revenue, of course, is based on current economy being where it is. And I can assure you with the US GDP continue to move lower because of stagflation, the tax revenue will actually drop lower. So it will also impoverish the population and destroy many corporations, because how many corporations can survive on debt that is 12%, where they borrowed during the last decade at less than 1%. And also, there was a BlackRock report just 2 years ago stating that more than 55% of US corporate debt are actually considered junk. And that is why, okay, I think the Fed will actually do a U-turn. Because because the Fed hopes, again, I stress on the in rate, hopes to hike the Fed funds rate just high enough to create a soft landing, resulting in a deflation and defeating inflation in the process. And they hope that QT would expedite the process. So by engineering a deflation, the Fed hopes to reverse course eventually and start cutting interest rate to stimulate the economy, hence preventing a full-blown recession. And because there's so much hopium there, these are all wishful thinking. On Thursday, 12 May 2022, Federal Reserve Chair Jerome Powell warned that getting inflation under control could cause some pain, and that the ability to execute a soft landing could depend on factors out of its control. So it's like, while on a high, the Fed smoking hopium would think that they are able to do, but once that high is gone, the reality steps in, the Fed, would actually face the consequences of its inaction all through the years of low interest rate and QE, which will actually make the whole situation even much worse than their expectation. Now, the US government, corporations, and citizens cannot tolerate interest rate hikes to 3% and QT simultaneously. The last time the Fed hiked to 2.5% with QT in 2018, it was forced to reverse course by 2019 due to the blow up in the repo market. So, and right now, you know, from 2018 to 2022, right now, the US debt has increased by several trillions. So that means that even hiking to 2.5% would be a challenge, leading to certain analysts like Société Générale stating that QT plus 1% could do enough damage to the US stock market. So meanwhile, US GDP fell to negative 1.4%. A negative print in Q2 will confirm that the US is officially in a recession. This will throw the Fed's plans into disarray. So I think that inflation will continue to rise due to several factors, resulting energy and food crisis from Russia-Ukraine war, which will force inflation to spiral out of control. Already gasoline and diesel have reached new record highs in the US. Out of control US government spending to support the war effort in Ukraine and demand from Pentagon to increase spending to maintain its advantage over peers. Now, the irony is that most of the US money goes to the MIC. MIC is military industrial complex. So right now they are going to throw tens of billions of dollars into Ukraine, which is just another rabbit hole. And just this morning, I read a report that the new howitzers that the US have promised Ukraine have arrived, and they were destroyed by a self-sacrificing drone launched by Russian troops. So, you know, you can see that they are shipped into Ukraine and then they are destroyed. Now, spending money in the war is actually very unproductive because it will just increase the cost of rebuilding, and money spent in a weapon that is eventually going to be destroyed means that there's no contribution onwards, okay? So US government will likely implement price control, resulting in even higher inflation as hoarding becomes a widespread phenomenon and producers cut production in order to reduce cost of inputs. On Thursday, 12th of May, 2022, House Democrats moved a legislation that would give the Federal Trade Commission expanded clout to crack down on allegations of price gouging by energy companies. This is just the start of price controls. So when, you know, the US have often touted itself as, you know, free market economy, but right now with rampaging inflation and with stagflation already happening, you know, it has to reverse costs and they have price controls. So I think it will be expanded eventually to other areas. And what price control does is that it will not stop inflation because even more people will want to hoard, okay? And because of that price control with cost of inputs rising, producers will be uninterested to expand production capacity because they will be suffering major losses. So who then will actually produce? If no one wants to produce, then the price of goods, there's shortage of goods, and that would force the price to move higher. And because there's price control, what we have then will be the establishment of a black market. So you can see that the mistakes that has happened in countries like Venezuela, you can see right now is unfolding very clearly, okay, in the early stages in the US. So as a reminder, the present inflation is not due to economy heating up, but by the expansion of money supply, war, and underinvestment, okay, to increase productivity and production respectively. So emergence of a new monetary and emergence of a new multipolar monetary system. So having said what I just now, the Fed would definitely have to do a policy U-turn. And if the US have to do a policy U-turn, okay, especially with the Pentagon demand that we need more dollars to fund our competitiveness against our peers, then what you have is that the US would actually print even more money, okay? And which is why there's a number of countries in the East are seeing that the US have actually been abusive of its privilege as the world reserve currency of the US dollar. So because the Fed at any time, okay, or the government, okay, based on the US dollar monetary system, okay, has allowed the US to massively print dollars at its convenience and weaponize it against countries when it sees them as a threat. So this is abusing a reserve currency. Now, way back when they wanted to push the US dollar as the world reserve currency after World War II, the US, gave the assurance that it will be a free currency. Okay, but over the decades, it has used it to others countries' disadvantage. Okay, abusing its use by sanctioning countries, forcing millions of people into destitute. Okay, and using paper money, okay, to buy real goods manufactured by other countries. So already the writing is on the wall way back after the financial crisis, where Russia and China central banks officials have stressed that there is a need to move back to a sound monetary system. And that was why much later over the years, they launched the BRICS nation with the BRICS Bank, the Asia International Infrastructure Bank, AIIB, as a mirror of the IMF and World Bank, because plans are already afoot by then that they need to disengage from the US dollar. So in late 2021, Assistant to the President of Foreign Policy, Yuri Ashakov, announced that Putin and Xi agreed to create an independent financial structure for trade operations that could not be influenced by other countries. And in March 2022, the EAEU, led by Russia and China, agreed to design the mechanism for an independent international monetary and financial system. Now, for those who are unaware, the EAEU consists of Russia, Kazakhstan, Kyrgyzstan, Belarus, and Armenia. The details would be revealed in late 2022. The ideas come from Sergei Glasnev, Russia's foremost independent economist, a former advisor to President Putin, and Minister for Integration and Macroeconomics of the EAEU, the regulatory body of that bloc. Now, the new monetary system will be based on the new international currency, calculated as an index of the national currencies of the participating countries, as well as commodity prices, which gold would likely play a pivotal role. Now, this is very important for us to understand the role of gold, because I will talk about it later. Now, the system involves the creation of a new digital payment currency, founded through an international agreement based on principles of transparency, fairness, goodwill, and efficiency. Now, the weight of each country's currency in the basket should be proportional to the economy of each country based on purchasing power parity, as an example. Now, a lot of people like to stress that, hey, the US is still the biggest country, strongest country in the world, okay, based on its GDP per capita and so forth. But the cost in the standard of living in the US is also high. Therefore, the best gauge of a country's economic prowess should be in the purchasing power parity. And for some years now, China has already reached as the leader of economy in terms of purchasing power parity. And Russia, people like to stress that Russia economy is nothing, it's just, it is just on par with perhaps Texas. But actually, in terms of purchasing power parity, Russia is rated 6th in the world. Okay, so that is why the new monetary system will focus on this issue because it addresses the cost of living. It will also have it will also, based on its share in international trade, as well as the population and territory size of participating countries. So that is why China is roped in, because China has the production capacity. It is also the largest population among the compared to the EU countries. Now, the basket could contain an index of prices of main exchange traded commodities, gold and other precious metals, key industrial metals, hydrocarbons, grains, sugar, as well as water and other natural resources. To provide backing and to make the currency more resilient, relevant international reserves can be created in due course. So this is not a one-time off system, but they hope to actually address it in due course, okay, by making adjustment. Now, for those who are unaware, yes, Russia has 70 trillion of resource estimation value. But another thing, countries like Kazakhstan is the world's largest producer of uranium, contributing almost 40%. So that is why even the smaller countries will actually have an advantage rather than being so-called marginalized, okay? So this new currency would be used exclusively for cross-border payments and issued to the participating countries based on a predefined formula. Now, this information source, if you want, you can read about it. It's written by P.P. Escobar from the Cradle. So very interestingly, okay, it is not only backed by the economy strength, the underlying fundamentals of the country, but also in terms of resource and key materials, including precious metals. Now, of course, there's a reason for this, is that only a currency that is backed by real stuff, is considered sound. And that is why the new monetary system is actually a new sound monetary system. So not only, in fact, this has been predicted by another genius of global economics in the form of Zoltan Pozsar, who actually mentioned that Bretton Woods III would comprise of commodity-backed currencies. Okay, so already the writing is on the wall. So how would it evolve? Now, it will start with the EU plus China and later integrated into the BRI. Okay, because trade is going to trade among BRI countries would actually flourish, okay, and it will become a major trading bloc in the years to come. Because if we look at it, including the BRICS and ASEAN nations, when it is expanded to these regions as well as to the SCO, which is the Shanghai Cooperation Organization, it would actually have almost 2/3 of the global population. Now, with a consumption of 2/3 of the global population, it's already showing where the new economy system will thrive. Now, the West is skeptical that the new monetary system could be brought into fruition owing to its complex calculations. Okay, so they still think that, hey, it's not workable. First of all, there's a lot of authoritative regimes in the bloc. It's not, they are not, there's no liberals that is going to push the agenda. But I think they underestimate that the population potential within the bloc. And complex calculations right now are very easy things to overcome. And interestingly, the people working behind this new monetary system consists not of economists mainly, but also scientists. Okay, that goes to show that there'll be implementation in the future, perhaps will be through AI, that will actually address the price movement fluctuations, everything that is integrated, so that there'll be some transparency in how it is being calculated. So of course, if you still think that the SWIFT system and all those the SWIFT system is actually nothing more than a messaging system, and other countries can just as easily do it. Okay, but interestingly, Russia already have an alternative to SWIFT, and so is China. Okay, and that's why now the trade like oil between India and Russia can be conducted in rupees. Okay, and why ASEAN is also participating, because China is their largest trade partner. So how will all this work out? Now, Russian commodities. Currently, Russia is demanding ruble or gold payment for unfriendly countries and local currencies for friendly countries. So Russia is pushing ahead that agenda. A number of countries within the SCO are already using local currencies for bilateral trade settlement, including Russia, China, India, Iran, and Pakistan. Indonesia is already settling her trade with China in local currencies. Saudi Arabia is considering accepting RMB as payment for its oil. Argentina is preparing to join the BRICS nations. So Brazil's President hopeful Lula da Silva proposed to implement a Latin American currency to settle trade among neighboring countries to avoid the US dollar. And here we need to be a bit concerned about Lula's predicament, because the last person who addressed the need for a pan-African currency was actually Gaddafi. Okay, so let's hope for his safety. The banning of Russia's access to SWIFT has energized the world to look at alternatives to the US dollar and euro as reserve currencies. So what has been happening to the US dollar? Now, US share of global reserves fell to 58.8% in 2021 versus 70% in 2002. So you can see that a lot of governments are actually very concerned with the speed of US sanctions. Okay, and I think we will see more diversification away from the US dollar as a reserve after the this information is until 2021. Yeah, so I think in this year alone, we'll see many diversification away from the US dollar due to the potential of the US government using its status as the US dollar as a global reserve currency to punish other nations. Now, in April 2022, the Bank of Israel added 4 new currencies, including the RMB, to its holdings for the first time in the country's history. The central bank will also trim US dollar and euro holdings in a bid to diversify its foreign reserves. And because this has been prepared for quite some time, just 2 days ago, I think the IMF have raised the status of the RMB in terms of its calculation of a basket of reserve currencies. So US dollar share could potentially see further drop once the new multipolar monetary system is introduced. Because when you look at the trade within the among 2/3 of the global population conducted in local currencies, it will actually drain the US dollar away from being used in a lot of trade. And what will happen to this US dollar? It will actually move back to the US, and therefore it will cause hyperinflation in the US. Now, why the US sees the need to maintain its US dollar hegemony is because sitting outside the US dollar is tens of trillions of US dollar that can actually flow back into the US. Now, all through the years using the US dollar as a world reserve currency, it has forced nations to hold US dollar in their reserves, okay, allowing the US to print money at the expense of other countries because it is exporting inflation to other countries. So as long as US dollar, there's a need for US dollar is there, US dollar will remain strong, but then other countries' currency will weaken, And that's how inflation is being forced to other countries. So printing of US dollar is actually the export of inflation to other countries. So how the geopolitical tensions will play out in the coming years. Now, the US is an empire in decline. We can see that through the kind of dismay, homelessness in the US, the violent crimes there, the demonstration, the riots, the racial-driven segregation due to politicians' views. Now, all these are actually signs of an empire in decline. It knows its days are numbered unless China falls, because China is the nearest peer competitor. So far, the trade and tech wars against China have failed to bring China to its knees. The US propaganda on Xinjiang and covert actions in Hong Kong funded by the CIA-linked NED have also failed. Okay. If you do not believe in my statement, please go to YouTube, and there are a lot of people verifying that life in Xinjiang is very much better than it's being portrayed. For example, Xinjiang has one of the highest GDP growth. Okay, the Uyghurs population has been growing. Okay, if there's genocide, it should be declining. So all this is aimed to actually paint a very negative picture on China, to disparage China, because that's the only way to do, you know, by forcing investors out of China because of their allegations. So for your information, the US have a $300 million propaganda against China, funded by the government. And all you need to do is just go to YouTube, and you can see how this is being controlled. It is made easy because the US has secured the global domination in the mainstream media. Now, the NED has been actively involved in color revolution in Myanmar, Thailand, Belarus, and Kazakhstan. And all these are pretty recent countries which have close tie to either China or Russia. Now, you can see that as soon as the US government pulled out of Afghanistan, there was actually a movement leading to riots in Kazakhstan. Okay, and if you want to know a bit more, please go to the source, which is the new atlas. Here, the person, Brian, actually shows real facts that are available on site. He's not one that, you know, have a YouTube, just talk about it, but he will show you sites that actually verify his claims. So if you are keen on geopolitics, there are a number of sites which you can look at. For the latest Ukraine-Russia saga, you can actually go to the Duran, you can go to the Alex Christophorou, as well as Alexander Mercury's site. Okay, you can also go to the new atlas. There's a lot of people talking about it. Okay, so NATO expansion into Ukraine was planned in advance to provoke Russia into a war with Ukraine. The idea is to sanction Russia economically and financially to destroy the country from within, resulting in the balkanization of the Russian Federation. Now, the US has been very successful in Yugoslavia, where they have balkanized the country into many smaller states, and they hope to achieve this in Russia. So that's the idea, okay? Because once Russia falls, the US can fully encircle China from the north. This is why the EU and US is pushing China to condemn Russia in order to create friction between the two neighboring countries. However, so far, the US and EU's plans seem to have backfired. Now, there's a lot of geopolitics that is happening right now so that the US can maintain its lead as a major superpower, because it's unwilling to give that up. So here I will lay out certain things that's happening and why I think China is next in line, okay, for a major crisis with the US. Now, the US is preparing for a conflict in China. It is hyping China's capability to invade Taiwan by 2027. The introduction of AUKUS and Quad are aimed to contain China in a conflict. Now, this is very important. On March 13, 2022, President Joe Biden signed into law a sweeping 1.5 trillion spending bill, which includes a ban on the use of any maps by the US Department of State and its foreign operations inaccurately depict Taiwan as part of China. So they already telling their people within the State Department that they should start treating Taiwan as separate from China. And here, just months ago, Biden assured Xi that the US haven't changed its stance on the one China policy. So just as in 1990s, when the Soviet Union collapsed, the US, although not written in any agreement, but it was recorded as saying that the US would not move to the east, and it will stay where it was, where it concerns the NATO. And right now, they've moved to Ukraine, and that was what forced Russia's hand in the issue. And just as it says that it accused Russia, that every country should have its freedom of choice of who they want to be aligned with. Then we have Solomon Islands signing just a security deal with China, and then US and Australia coming out and accuse of China's intervention into their region of exclusivity. And Solomon and saying that this, if they continue to go on a development militarily, that will be the red line. So what happens to the freedom of choice? So you can see that a lot of words that are being said in the geopolitical scene have a lot of hidden agenda. Okay, just as all this that is being waged in the mainstream media, to have a balanced view, I would urge many of you to look into alternative news channels that is still available in YouTube, although many have since been cancelled. Okay, and on 27 April 2022, Liz Truss, UK Foreign Minister, said NATO should protect Taiwan too. So on 10th of May 2022, the State Department website section on relations with Taiwan removed wording on not supporting Taiwan independence and on acknowledging Beijing's position that Taiwan is part of China. So all this has a certain agenda. The recent US-ASEAN summit is aimed to rope in support to contain China, but I think it ended in failure because it treated ASEAN members like beggars, allocating 150 million in aid, of which a majority of it is aimed to build American naval facilities to maintain maritime safety and security, while they pump in 40 billion into Ukraine. Okay, so you can see the double standard there. The provocation towards China will gather pace in the coming months to force China's hands into a conflict with Taiwan in order to drain China's military resources. Now, here's my point of view. It may be true, it may be not. Okay, so I leave it for you to assess. I suspect the US Congress may attempt a move to pave. Okay, to pave the way to accept Taiwan's declaration of independence should the province chooses to do so. So they are right now making these moves, okay, to say that, hey, it's okay, we'll back you up. Okay, just like they tell Ukraine, it's okay, we'll be behind you. Okay. However, such a move by the US Congress is unlikely to provoke China into an immediate war with Taiwan unless the province itself declares independence, which I think it won't. In the recent survey, I think there were a lot of people who wants to maintain the status quo. Now, China will likely retaliate against the US politically under such a circumstance, since it is politically motivated, which could include cutting ties completely with the US. Now, in the event of conflict, I don't see the US putting any boots on the ground, but will encourage its allies, such as South Korea, Japan, Australia, and New Zealand, to support Taiwan. I think it will the US intention that it will provide support in form of military hardware because the US wants to maintain itself as the strongest military power in a post-war period. And this is what they are doing in Ukraine right now, okay, to drain Russia, because Nancy Pelosi has gone there and reiterated that we will support Ukraine until the war is won, okay. So, but I think unless it turns from bad to worse, US will then really put troops in the ground, okay, because of the pressure to pressure so-called to pressure Russia into a long-driven conflict. If not, they will actually encourage NATO regional countries in Ukraine to support Ukraine in their war effort by putting boots in the ground, but the US will still be on an advisory panel. Now, what I think, if war or military conflict really happen, the US will use its navy to blockade the Straits of Malacca to choke off the supply of much needed raw materials to China. And that is also one reason why I think China is not going to start a war, because there's no point, okay, to fight against the US when there's not when you do not have the raw materials it needs, okay, to meet that kind of challenge. So China postures will still be on the defensive side. Now, the incentive to the US, of course, when they start a conflict with China, seeing how successful it was with Russia, is the seizure of Chinese assets globally, wipe off the $1 trillion debt it owes China, and enrich its MIC. So that is the true agenda, because the US knows that if the new monetary policy goes, becomes a permanent feature that challenges hegemony, it has no alternative, because its survival is at risk. Otherwise, US will go into deep depression, okay, and its population will be impoverished, okay. So this is actually somewhat a war of survival for the US as well, okay. And let's see how it will unfold further. Now, China is not ready for any military conflict in the medium term unless Taiwan declares independence, which will then force it into a military conflict with the province. Now, China needs time to expand its BRI infrastructure so that it can secure raw materials over land. This is important in view of potential blockade in the Straits of Malacca. And that's why you see that China now is quickly moving eastwards. They are already trying to secure raw materials in Iran as well as Afghanistan, where Chinese have been delivering aid to build up relationship with the Taliban government. Okay, so that is very important because it wants to have overland supply of raw materials rather than through the sea route, and also the linkage in terms of linking the entire ASEAN through the rail lines, okay, from Cambodia, Thailand, Malaysia, Vietnam, okay, all the way to Kunming in China. Now, the introduction of the new multipolar monetary system is aimed to cripple the US economically and financially so that a military conflict could be avoided. So right now, there are certain neocons or warmongers in the US are hyping about nuclear war, making preparation mentally for the US population to prepare for a nuclear war. You know, all these are being aimed by the mainstream media as a side ops, okay, changing people's perception. So, and I think Russia's and China's intention is that they would want to avoid a direct conflict with the US because in the end, everyone loses. And that's why they are working on possibility how to exclude themselves from sanctions and financial friction, but in the meanwhile also could damage the US economically and financially. So meanwhile, it will continue to build up its military as a major deterrence to foreign forces and expand its anti-access area denial, which is a de-coverage. So China, that's why you see a lot of development in China of its navy, okay, and also the expansion of its missile technology to be able to protect the country in the event of any potential conflict. And the RAND Corporation, which is a major US think tank, has the idea that if the US do not rein in China within the next few years, or bring China to its knees in the next few years, the US would have lost its competitive advantage, because major economies or institutions predicted that by 2028, China could potentially, economy could potentially exceed the US. And by 2035, just based on the current spending rate of percentage to GDP, by 2035, China's military spending would already have exceeded the US. So that is why now the world right now is very worried of it falling into what is called a two-digit trap, where an emerging economy rise to challenge the world's largest economy, and more often than not, it resulted in a major military conflict. So that is why it's very important for us to understand what the potential eruption of military conflict is, in order for us to make certain adjustments. So sectors that will benefit in the coming years. Now, I think the commodity bull cycle has only just started. And if we look at the Goldman Sachs Commodity Index versus the S&P ratio, this was during the oil embargo, the oil crisis, during stagflation, and exit of the gold-backed dollar. So you can see that commodities price went up simply because people has lost faith in the reserve currency, and they see the need to hedge by owning real stuff. Okay, so then we have Paul Volcker coming in with doing a lot of heavy lifting in interest rate to force the commodities to go down, but it went up another peak during Gulf War I, because suddenly everyone is afraid that it will lead to another energy crisis. Okay, but after the war became very short-lived, commodity prices started to trade down, and during this period leading to the global financial crisis, we see China injecting 4 trillion into the economy to boost up demand again. But because of continuation of QE, as I mentioned earlier, lack of investment, lack of because of the commodities bear market, so commodities price started to fall. Okay, and even right now, despite 300 trillion in debt, QE being extended, it's just at 0.8. Now, if the ratio move up to its mean, which is at 4, it will entail a 5-fold increase in commodity prices, okay, which then would lead to bumper profits for those companies that are in the resource industry. If, let's say, situation becomes worse like prior cycles of crisis, and let's say it move up to 8, then that would entail a 10 times increase. So at this level, the commodity bull cycle has only just begun. Now, looking at it, either it has to move up, okay, due to inflationary forces, or the S&P would actually have to fall all the way down in order to reach some equilibrium. So that's why with the current stagflationary situation, we could see S&P continue to go down, okay, and commodity prices moving up to a point where I think the Fed would be forced into action by the Biden admin due to coming midterms election. The economy cannot be in a recession. We will see the Fed doing a U-turn, and then we will see the index of the S&P moving up. But the commodities will also move up in tandem, but even more aggressively, because that means that they have to pull out QT, okay, and focus on QE, lower interest rate, and it will just debase the dollar. So why this could happen? Now, high interest rate environment will prevent investment in exploration and development of the resource-based industry, leading to chronic shortfall in new discoveries. It also prevents producers to invest in capacity expansion. Energy and food crisis, energy and agricultural sectors will outperform. ESG economy increase in the demand for battery minerals and conductor materials. So companies that focus in battery minerals and conductor materials such as copper, silver, battery materials such as cobalt, lithium, nickel will also benefit. Disruptions in the global supply of commodities due to Russian-Ukraine war and COVID lockdown in China impacting global logistics. So this would actually help the logistic companies, okay? Now, recent slowdown in China will force the government to ease, including expansion of its infrastructure build-up, pushing the demand for raw materials higher. It recently introduced incentives for families with three kids to buy a home. The arrival of recession will eventually force the Fed and ECB to ease, expanding the money supply and forcing the price of commodities higher. Commodities are the ideal hedge against inflation in such a situation. Food producers, resource-based and mining companies, logistic companies involved with the shipment of commodities will do well. So gold as the ideal inflation hedge. Now there's a lot of saying that high interest rate will actually be bad for gold. And this is a chart which I shared very frequently in my Facebook as well as with members of our group. Okay, now this chart shows that historically gold has always risen with interest rate hikes, start of interest rate in red and gold rise in yellow. You can see that over here, interest rate started to go up, but look at the price of gold. It also went up. And over here, okay, interest rate started to go up from near 0% during Alan Greenspan's time, okay? And then you see here gold trending up. So Alan Greenspan actually started to hike, okay? So gold also move up. Then over here, 2015, the Fed started to hike interest rate, and then you see that gold actually moved up as well. But subsequently, every Fed rate hike has been, if you follow the downtrend line, has been followed by a Fed easing, which will then, like in this situation, push gold even higher, and over here, gold reach even higher. So that is why, you know, that the Fed can actually maintain interest rate, as the long-term chart shows that over the past decades, it cannot rise beyond a certain limit to cause the entire collapse of the economy. And that's why the Fed will have no options, because it needs to protect the interests of its elite. They cannot see the destruction of their asset. So this chart also shows the policy of strong US dollar and high interest rate as being negative for gold. Now, why, you know, like gold price, you know, have not fallen significantly, even though the US dollar has gone up, simply because a lot of people see the USD as an ETF for the euro and yen, because these two currencies form the bulk of its weightage against the US dollar in the US dollar index. So recent sell-off in crypto market has also revealed the policy of Bitcoin being an inflation hedge. Now, there is, of course, two things that happen. I do own some amount of cryptocurrencies, and I'm a believer that it could help change certain, it could help change for the better of society in some ways. But I think right now, there's a lot of involvement of institutional investors. So although the cryptocurrency market, welcome the introduction of ETF-based Bitcoin and such, they are nothing more than an effort that will be used to contain and manage Bitcoin, just as they did with the introduction of ETFs to control the price of gold and silver over the last few decades. So until this link is broken out, okay, then cryptocurrency will see its true freedom. But as long as it's linked to financial institutions, they will be at the whims and fancy for them to manipulate its price through heavy dumping. And then when the market, there's a sell-off, then they start to buy and then they do another pump, just as they have been doing over the decades with gold, okay? As I mentioned, the London gold pool, and then what has happened over the last 2 or 3 decades by using the COMEX futures to manipulate the price of gold. Now, very interestingly, recent sell-off in gold could be an attempt by the West to drive the US dollar higher to put a cap on the ruble's rise, and algo's reaction to a stronger US dollar and higher US Treasury yields. Now, that is why the Bank of International Settlement, the BIS, has seized its role in actually helping to manipulate, together with the LBMA and the COMEX, the price of gold and silver especially, because these are actually true monetary assets. They have been for thousands of years, and it is being used to manage it so that the central banks themselves can actually buy these assets on the cheap, especially gold. Now, the underlying asset of most central banks, outside of bonds, which can actually depreciate in price, okay, is actually gold reserves. Because if the situation becomes worse, as many economists predicted, if the entire financial system is at risk of failure, very likelihood central banks would use gold and revalue it higher to wipe clean their balance sheet. This is what some economists have predicted, okay, leading to a revaluation in the price of gold. But right now, okay, the attempt by Russia to launch a new monetary system have resulted in the urgency among the Western banks to force the US dollar higher just to put a cap on the ruble's rise, because that would actually show to the whole world that their narrative that Russia is on the verge of collapse as being a false agenda, having false agenda. So that's why, attempts is being moved to sell gold, sell precious metals, because they are also among the forex pair, to push US dollar higher. But in the gold and silver OTC market, which is many times higher than the COMEX market, there is actually a physical shortage of gold and silver, especially since Russia, being a major producer, have been moved out of the market. And I think we could soon see gold moving higher, simply because there's not enough physical to back all the paper derivatives of gold and silver that's being sold into the market. And this shortage would actually result in huge backwardation of meeting the physical needs, the demand of physical gold and silver from investors who sees the fallacy of the entire system. Now, this is to show, also to show the ratio of the S&P to the gold miners. Okay, you can see that this ratio fell in 2011 when gold price hit a new record high. And even though gold price hit a new record high in 2020, the S&P has remained very strong. If let's say it moved back down here, it will entail like what the commodity index show, almost a 5 times increase. Okay, so And I think the Fed will eventually do a policy U-turn due to the destruction in asset prices, causing the US dollar to tank. And a lot of the strength in the US dollar is driven by the narrative, okay, that the US economy is strong, but as new economy indicators show, okay, or the Q1 GDP shows, US is just one step behind recession. Now, this will ignite the market, but real market gains will deteriorate owing to rocketing inflation. So the S&P may do a reverse course, okay, shooting higher, but in terms of real gains, it will actually fall short of expectation because it is being pushed also by inflation. You know, for example, over the years, Venezuela's stock market has been the best performer, okay? But that is because the Venezuela currency has actually, has devalued, that no one is actually interested in. So commodities will still outperform the S&P in this case. So that's all I have, but let's talk about IFS. You have, we mentioned it in our site and so forth, okay? Now, here what we do is that we study global economic, financial, commodity trends, government policies, and how they could impact specific industry. From there, we perform case studies on companies which can potentially benefit from such trends. So just to share some what we have done, okay? So even before the oil crisis started, we have actually seen what could happen. And on June 11, 2020, we shared with our members that the time is right to enter the oil sector. Crude oil was trading at $37.76 per barrel on that day, and crude oil is trading at $108.40 per barrel on 17 May for a gain of 205%. Now I can tell you that crude oil will be moving higher soon because, number one, the OPEC has already mentioned that they will not be able to meet the shortage of oil. And secondly, the price of oil fell in tandem with Shanghai lockdown. And right now, Shanghai is gradually reopening. So the oil price will likely move back to the 120s to 130s region. And if let's say now another thing is that the US Congress is actually working on a bill called NOPEC, which means that they can actually sue OPEC countries for antitrust operations, okay, or antitrust behavior, because they see OPEC as manipulating the price. Now, if let's say that happens, OPEC countries have warned that it could actually push the price of oil to $300 per barrel. So there's a lot of financial war, economic war being fought, okay? So let's see how it goes. But during that time, we actually focus on, we have a case study on Shell and Chevron, and together, both companies have gained 73.1% and 78.7% respectively, excluding dividends. Of course, if we include the dividends, then likelihood it will be in the 80s region. So then we also look at the commodities market. And 25th of June 2020, we shared with our members that the time is right to enter the base metal sector. We featured Altius Minerals in our case study. Altius Minerals has since gained 106%, excluding dividends. So we also shared a case study in January 2021, where we highlighted Turquoise Hills to our members in our case study, noting that the time is right to enter the copper sector. Now, that is based on our research, which shows that due to the ESG economy and also the shortfall of investment in mineral resources would actually cause a shortage of copper from 2025 onwards. So Turquoise Hills was later became the target of acquisition by Rio Tinto, another mining giant, giving it a gain of 159.3%. Then, of course, as an IFS member, you also receive weekly update on the stock market performance, namely the US as well as Hong Kong. Okay, and we talk about a lot about economics, the economies of US and geopolitics in Europe, as well as some occasional studies on China, and to give you abreast of what's happening. Okay, and of course you can receive some alert via our WhatsApp. For example, in January 2021, I highlighted to the members that I'm making a purchase of CGN Mining, which is a uranium company, when it was at 47 cents. So it did reach a high of $1.53 in September. If let's say have exited, would be a 25% increase. For that matter, I've not existed for disclosure, even though I own the stock. And I see opportunity to actually buy into uranium stocks, because the world will face a huge shortage of uranium in the next 2 or 3 years because of insufficient uranium that is being put into the market, owing to a need right now to actually speed up the development of nuclear power plants to meet the energy shortfall. So these are what you can get as a member, and our recruitment now is open. Please visit investforeignshare.com, and if you like to read more of my writing, you can actually go to my Facebook page. You can follow and like, and if you have any queries, you can send to this email address here. So that's all I have. Thank you.
Okay, thank you, PC, for all the sharings and insights. So can we do some quick Q&A?
Sure.
Guys, if you have any question, you can type in the Q&A box, so it's easier for us to find it. So Evelyn is asking, with all this crisis looming, what is the opportunity for the investor? What field should we look at?
I think the whole overall market is very bearish. Even commodity looks bullish, but I think you need to have patience, okay? Especially where the commodity is concerned, because any sell-off in the S&P will also be reflected in other underlying stocks. But I think looking at the situation, the Fed definitely will be forced to do a U-turn, and when that happens, commodity would actually be on a revenge trail, including those companies that have underperformed. They will actually outperform. So this is a sector that I think you should look into. And if let's say you want if you want to be, as something that is a sure bet, I think the energy crisis goes to show that oil as well as uranium companies could be the ideal destination for many investors. Now, this is not financial advice, okay, but this is from what I have read online. So next question.
Su Yong. Do you mean the Fed will reverse QT to QE in the span of 1 to 2 years? If that happened, would the US stock market reverse to bull again?
I think we no need to wait 1 or 2 years. Things could happen very fast, okay, in quarters. Because as I mentioned, the US is just one step behind recession. A negative print in Q2 would actually light up the need, okay, or force the Biden administration to push the Fed to reverse their action. In fact, the Fed, if you read the Fed's FOMC minutes and such, the whole narrative is that we are hiking interest rates now so that we can actually cut them down later. Okay, so it's all a pull and push narrative, okay, that they want to tell that they are in control, but in actual fact, they have already loosened control. They have already lost control. So I think you no need to wait 1 or 2 years. Likelihood, although people say that the Fed will actually reverse course in 2023, I think it could be much sooner than that. Okay.
Yeah, PC, can you put the slide back to the previous one so that they can check out the site and
Okay.
check out your Facebook page? Okay, so Gary wants to know how high can gold reach? Like, how long will it take? What do you think?
I think the now what is going to happen is that in the coming quarters, the new monetary policy would be introduced. And since it will be backed by commodities, we will see a rush into commodities, and that could push the price of commodities higher. And that would include gold. Now, gold is often shunned by the Western banks and Western financial system because they actually don't have much left, because most of the gold has been moved from the west to the east. Okay. And make no mistake that Russia and China collectively are reported to own about 32,000 tons of gold through their sovereign funds and other and placed elsewhere. Okay. So gold is definitely in the feature of the new monetary system, but the reason why they want to expand it to all commodities is because they expect if they just put gold and silver, it will be manipulated by the Western banks and Western institutions to push it lower so that it destroy the underlying currency value. But because of that, they actually expanded to all commodities and based on economic purchasing parity, so that it leaves little options, okay, that they cannot short the entire commodities market. Look at nickel. When one company shorted nickel, it almost went bankrupt. Okay, so that's why they expanded it all to about, I read that it's about 20 commodities, including gold and silver. But to draw some parallel, okay, people like Rickards, Jim Rickards, people like several other economists, okay, like Alistair MacLeod, actually wrote that if, let's say, they have to revalue gold to back up their deteriorated assets for central banks or the, especially the Western financial system, gold has to be 5-figure. And if, let's say, we put gold in contrast with 1980, where gold actually reached a new record high at that time, where gold actually went up 26 times from 1971 to 1980. If we were to draw a parallel with adjusted inflation, monetary supply, money supply, and all those, gold should be valued at about 8,000, according to Yvonne Van Gruijs. But to really wipe off the entire debt of 300 trillion, where gold market right now is just a few trillion, gives you an idea of how, if they were to wipe off the entire debt, gold can actually be very, very much higher. So it depends on the financial institution. But let's look back on a parallel line to 1980. And that's why a lot of people like Michael Oliver, who is actually a momentum strategist, predicted that gold should at least be closer to 8,000, okay, based on the underlying fundamentals and momentum structure over the past decades. Hope that answers your question.
And following up, Cecilia, I want to know, would you rather use a physical gold or the gold ETF, which is
I
much more
think,
liquid?
yeah, gold ETF is definitely very liquid, for example, GLD, but it is precisely of this ETF, just like the Bitcoin ETF, is used to manipulate the price lower, okay, because they are able to, because if you go to the GLD ETF, they actually mention in their terms and conditions that it may not be 100% backed by physical gold, okay? So that's why if you want real insurance, you can buy physical gold or physical silver, since gold and silver ratio right now is at its among the highest, okay, at 80/1, versus in 2011 where the ratio was actually 30. 31. So that goes to show that potential for silver could be much better, physical silver, rather than silver ETF like SLV. Now, if you really want to buy gold or silver ETFs, I would think a better option would be the spot physical gold or spot physical silver, where it is 100% backed by physical gold and physical silver. Also, there's no derivatives on that ETF, whereas the GLD and SLV, they also have options. So when you have options, means that the opportunity to manipulate the price is also higher, and furthermore, they are not 100% backed by physical gold or physical silver. But of course, if you want to own physical gold and physical silver, is also another type of insurance. Okay. Now, I myself, I own physical gold and physical silver, not in any ETF. Most of my money is invested in junior mining companies. They have taken a beating. Okay, my portfolio has actually suffered, but I believe that junior mining companies, because they are the explorer, they are likely to discover good deposits, and they will be the target of takeovers. So, for example, during the height of the 2011 gold market, where gold reached a new record high, some of the companies were taken over based on their resources at between 100 to even $200 per ounce of resources in the ground. And most of the resources in the ground of junior mining companies, they are secured at around a few dollars to maybe about more than $10. And resources in the ground right now is valued at about $40. So if, let's say, during another bull market, okay, the resources in the ground will be worth much more. So that's why I'm into junior mining companies. Of course, my portfolio has suffered because most of them are actually junior mining companies. But I myself believe that if you have hit a few out of the many, then that would actually be very life-changing. Okay, for example, uranium. In the last uranium market, one particular company, I think it was Paladin Energy, from 10 cents, it went up to $10, okay, during the uranium bull market. That's why I also have substantial money invested in uranium mining companies. Okay, next question.
Yeah, Stephen want to know your opinion on euro versus the US dollar currency relationship. Is the euro actually the USD? I mean, full hedging between USD and euro.
Now, as I mentioned, the dollar index is basically, bulk of it consists of the euro and yen. Now, as long as the euro and yen keeps falling, and I think euro will continue to fall, there's no doubt about it, okay, it will actually boost up the US dollar. But the thing is that as soon as the Fed reverse course, okay, then the US dollar would actually tank very fast. So I would think that if you are doing Forex, you need to keep abreast of how the development of the Fed is. Although I think that the US dollar is right now, according to some analysts, is being pushed closer to 110 because one of the key things is that if the US dollar becomes strong, then the inflation could also be much lower due to favorable exchange rate. Especially right now, US trade deficit have reached a new record high of over $100 billion. So if, let's say, it can help reduce the trade deficit, they might well allow it to, but I think a stronger US dollar would be very disruptive to the overall economy, especially in the European economy, the Japanese economy, as well as a lot of emerging market economies. So if, let's say, that happens, then it will, because a lot of these economies have borrowed US dollar, and if, let's say, the depreciation of their currency happens, then they would actually put a lot of the banks in a bind where non-performing loans will actually skyrocket. And if that happens, then we could have another financial crisis. So that's why I think that if you want to trade, you have to be very careful, watch what's happening, read more about what's happening in the repo market, and also what's happening in emerging market economies, because I think they cannot allow it to stay very high for long, because that would blow up a lot of the bank's balance sheets. Okay.
Okay, great. Let's get to one more question. This is from Sazrin. What's your thoughts on the tech stocks? Got hammered so much recently.
Buying on the dip, I think now is not the time. Okay. And there is now a change of opinion among venture capitalists. Previously, venture capitalists were highlighting that their KPI for a lot of tech companies is based on the TAM, or total addressable market, even though when the company is taking a lot of hit, in terms of deterioration in balance sheet, which they can actually raise capital again. But right now, with higher interest rate and a lot of them being zombie companies, it is unlikely to be sustainable. Okay, so some tech companies might fail. And if you want to look at even strong companies like Amazon, now, what is happening is that we know for sure there's going to be reduction of goods in the market, and the raw materials of goods is going to increase. So the price of the cost of sales for Amazon is going to increase. And furthermore, what is happening right now is logistic costs have increased as well. So Amazon, which thrive on very narrow margins, will be very badly affected. And perhaps if you want to buy on the dip, one of the key things is to look out for the earnings of previously profitable companies, which are in the semiconductor sector, because as I mentioned, with neon gas being affected by the shortage, chips price would actually have to go up. But the challenge here is that deteriorating economic situation, for example, mobile phone makers have already warned suppliers that their orders would be much lower. So that would actually reduce the demand for semiconductors. So right now, will the rise in the price of semiconductor be able to offset the lower demand? That remains to be seen. But if you want to buy the dip, you have to be on a gradual approach, not allocate capital all at once, but you have to wait for the direction from the Fed, because as long as the Fed narrative is that we are going to be very hawkish, the next step will likely to tumble further down. Okay. So next question.
Okay, let's get to a few more questions. Like, would palm oil be included in the new monetary system? Do you have any idea?
No, definitely not,
Okay,
because those countries are not involved.
Okay, let's do the next one. Chun Lin want to know what are your thoughts on China and Hong Kong stock, which have taken a beating recently.
I think on the long term, it's good. Okay. Mainly because China is working very hard to disengage itself totally on reliance on foreign technologies. And in the technology sector, you can see that China is well supported by very strong rare earth industry. They are very advanced in the AI. They are also very advanced in communications, where they are already working on 6G quantum technology. And in the EVs, they are right now fighting head to toe, okay, with Tesla. So their battery technology are well advanced of any other countries. So that's why for the long term, I think it will be good, but their only weakness is in the manufacturing of semiconductor. But this could change as China has been investing heavily in alternative materials, such as graphene and gallium, which could change the dynamics of the semiconductor industry, or even quantum chips. Okay, and there are certain revelations that right now chips within mobile phones need not be of higher performance, because that could be through better communications, for example 5G or 6G, that could put the processing back to a major center that runs the processing, but is communicated to the handphone via 5G and 6G. So this is also being explored. Huawei just recently have a patent where it has proven that through stacking process, it can actually have near 7 nanometer performance. So all these are actually being explored in China. And if you have a good, you can actually pick up some of the tech sector gradually, because there'll still be ups and downs. Yeah.
Okay, thank you very much, PC, for taking the time to help with all the questions. And guys, if you want to check out the course, is investforeignshare.com, where you will hear from PC directly, right? So we publish the update, and also he's also constantly replying members in the WhatsApp group if you are interested.
Yeah,
So
I
thank you
also
very
give
much.
updates there. Yeah. Yeah,
Yes.
thank you very much, Casey, and thank you all who are logging in. Please visit our website. Have a very nice day. Bye-bye.
Thank you. Bye-bye.